Hey YouTube, this is Zach with the English Financial, and today we're going to be doing a earnings review based off of their earnings that happened this past Thursday after hours. Now on Friday there was a very large day. This volume heavy that you see right here on STEM is going to be reflective of more than 3 times what the average daily volume is on the stock. And that makes a lot of sense because as you can see here on the stock price, we filmed our earnings preview video. The stock was around $6.80, and since then it has gone up to as high as $7.48, as well as low or currently back to where it's sitting today, pre-market, or I guess on Sunday, of $6.94. I would attribute this large drop off though to be more so reflective of what we saw in the broader market, recognizing that there was a number of much larger companies that were moving the market, and overall STEM's ending up positive 2% on that day bodes very, very well for the company. And there was a lot to like about the earnings report. To get started there, let's go ahead and head over to that slide deck. As always, as we're looking at these results, this is my opinion of the information. Please do your own due diligence. I am going to link this report, as well as you can find it on their website, both of which will be available in the description down below. And there includes a number of cautionary statements regarding forward-looking statements, recognizing that all of this could change depending on the macro environment. So without further ado, what I want to highlight from this report is that from a revenue perspective, STEM continues to deliver. They continue to be on the upper edge of their guidance that they released last year. And in addition to that, they continue to grow that recurring revenue that you see here. Again, they've labeled this CAR. The SaaS industry is really going to be focused on what are they bringing in from a software perspective. But it is nice to note that they have this recurring revenue, but a lot of that is going to be based on the services side, which again is going to be their team. Those margins are going to be in the 40 to 45%, which is one of the reasons why we continue to see those gross margins increasing. However, the software side is going to be that 80-85% margins that we really need to see those explode to really see this increase at a more comfortable level. The important thing to note out of all of the information available here is that they are still on track to achieve adjusted EBITDA positive in the second half of this calendar year. And they still have this on the slide deck, recognizing that earnings were already in August, meaning that they've already had another month to reaffirm or change expectations here. So the fact that they are reaffirming that full year guidance is going to be a big deal. If I scroll down below to those results, and if you want to see some of that other information, please take a look at the earnings call that I showcased. There is some cool stuff in there. But also, if you want to take a look in the presentation itself, that's once again linked down below. Now, from an overall financial metrics perspective, it's super important to note that we're very happy with the revenue growth. They have not increased their full year guidance despite another beat, but we're happy about that. And again, the GAAP and non-GAAP gross margins increasing continues to bode very, very well for the company's capabilities. However, I will note that as the top line revenue continues to grow, these gross margins are going to need to be quite a bit higher for the company to really show a high level of net income. Keep in mind, you've got companies that are true software plays that are having double, triple, quadruple some of these numbers, and as such, they're being treated much more favorably in the stock market. Despite that, if we are to treat STEM as more of a hardware reseller with some of this information available, this increasing trend does tend to bode well for the company. It's also important to note that they are continuing to change their expense structure. They've decreased a lot of expenses last year. They've done so again this year. And again, as they continue to build that capability, it will continue to benefit the company. Going forward, it's also important to note backlog is still increasing, albeit lower than it has in prior quarters. But that backlog is going to continue to drive pipeline for the company to be able to deliver. And in addition to that CAR going up as well. Again, my one caveat and concern with that CAR number is that does need to go up pretty materially over the next 2 quarters. For that to be meaningful, I would really like that $100 million number because it is nice and a round number, but also that means that it will have increased by more than 20-25% from where we started the year at. So it's important to note that again, it continues to grow very well, but again, this is going to be what sets the foundation for the overall company valuation, and $100 million looks very, very nice right there. Once again, they did reaffirm that full year guidance, and I think that this is super important because they've been on the higher side of revenue for quarters 1, quarter 2. They continue to say that $600 million numbers right here in the middle is going to be their target. There is a number of quarters left that we're going to have to see that deliver on, but again, booking staying strong and revenue staying strong are both going to be super important for the company to be able to continue to achieve that positive net income that we're looking for into next year. So if we have a strong recurring revenue component, we have those stronger margins that we're expecting to see, as well as the possibility of having a positive net income next year, I think is going to be a massive deal for this company. I would like them to have a little bit more confidence as they continue to deliver these numbers, but recognizing that they're expecting to do more than they did in Q1 and Q2 combined in the third quarter, it's going to be very important for them to continue to deliver and showcase that they can do very well from a revenue perspective. Now, it's important to note that there is going to be a number of key takeaways here, as well as some great charts here for the Q&A. However, I'm going to go to the press release to talk to those a bit more. So what I'm showcasing here on the screen, we've got the revenue numbers here, but I want to take a piece that I found to be super interesting and talk about a little bit more, because you're not going to really see it as much unless you listen to the company earnings call. And that's going to be here. You can see our December 31, 2020 numbers, and then the June 30th, 2023. So what I've got here is the assets, and I've got cash is dropping once again, but in addition to that, the short-term investments number has dropped very materially. So this obviously would lead to a very worrisome number when we get down to around 137 million of essentially usable cash. But there are two things that I would note. One is that inventory skyrocketed over the past 6 months. They mentioned this on the call. They have bought all of their inventory for the calendar year of 2023. Now, I think that this is a strong move, recognizing the current macroeconomic environment. We're seeing rising fuel costs once again. They are locking in those costs, but unfortunately, you're going to see that reflected here in revenue or inventory. The other thing I would note is we also are seeing a large increase in accounts receivable. So they mentioned these two items specifically on the call in relation to their cash balance, because if anyone sees that large of a cash balance going down, that immediately causes concerns. But what they highlighted on the call is historically they've seen a larger percentage of their accounts receivable in the first half of the year, and this year they're expecting that to be in the second half of the year, as they deliver quite a bit of their larger hardware projects. So these two items I would expect to materially decrease between now and the end of this calendar year, meaning that the company is in a comfortable cash position and they expect to be in a stronger cash position going into the end of this year. That means that they are not expecting any form of additional share dilution or share issuance at this point in time. Again, that's how it phrased on the call. Don't hold me to that, but I think after seeing this, I was initially worried, but following that feedback on the call, it continued to showcase that I was quite a bit more comfortable with that level of detail and information. The other thing that I wanted to showcase here is they have begun breaking out this revenue between services and other revenue and the hardware side. Once again, STEM has definitely transitioned or showcased themselves to be a hardware-based company. So they are that hardware reseller, which is why the services and other revenues that you see right here of that $31 million, this is going to be what is primarily driving that margin that we're seeing as the company continues to increase. The nice thing is that this is increasing at a quite a bit higher rate than the overall hardware side, so those margins should continue to improve. It's also important to note that despite the fact we have those impressive sales growth numbers, we're not necessarily seeing that occur the same level in terms of the total cost. So it's important to note that once again, the company is continuing to perform very well, and they are trending in the right direction on a number of the positive focuses for the company, which is going to be really growing that gross profit line and hopefully down below in that net income line once again. You may be confused as to seeing that positive net income number. I would highlight that the large percentage of that, and the reason that that's coming about, is because they are adjusting their debt package that we saw again announced in the last earnings. And that means that they were showcasing a positive 59 million. And again, if we were to back that out, you would see that actual negative number that we can see up here, which is more so that negative 34 million. Again, the company continues to do well. They continue to show that large drop in cash, but a lot of that is going to be on the inventory and accounts receivable side. So overall, what is my takeaway from the company? And I'll pull this up to look at the quarter highlights. You can see the cash position is something that I highlighted in the review video or preview video that I was worried about. And I think that they're in a good position. The reason I say I think versus I know, despite looking at those numbers, is they've still got to deliver. Otherwise, it's a large piece of accounts receivable and inventory, and you can't exactly sell inventory in its current state. That's something that their team is standing up for clients. So once that is installed, once we see that cash balance be built up again, which they mentioned on the call that it is expected to grow between now and the end of this year, then I'm going to feel a lot more comfortable there. They said that they're not looking to do a share issuance. We're not expecting another capital raise, and that makes me feel quite a bit more comfortable. The second thing I want to highlight is that revenue growth. Once again, they've hit numbers on the upper side. That was the first and second quarter. They're expected to do more than that in just the third quarter alone. They're going to have to show a very strong quarter there, inclusive of some of those larger hardware deals, to really move the needle for the company. The past 2 years, they have showcased very strong starts to the calendar year in the first 3 quarters before really dropping the ball in the fourth quarter. It looks like they have their ducks in a row. They should be able to deliver this calendar year, but I think that anything less than 600 million this calendar year is going to be a failure, especially if they don't do that in a positive adjusted EBITDA format. And that's going to be my point 3 for the video, is they clearly stated that they expect positive EBITDA between now and the end of this calendar year for the remaining 2 quarters. However, I want them to be more forthright in showcasing that they expect to be income positive next year. And that while they talk to that, I would like some confirmation that that is in the plan, because if they are going to be fully positive, I think that the market is going to treat them quite a bit better. And I think there's going to be a lot more upside from their current price of just south of $7 a share, recognizing that a company that can stand on its own 2 feet from a cash perspective and a net income perspective is going to have quite a bit more longevity. And that opens up a lot of opportunities for the company to continue to grow from a market capitalization perspective, as well as for another larger company to buy them out. All in all, once again, management team continues to execute, the company continues to perform well, and I look forward to seeing how STEM performs over the next quarter, and looking forward to checking back in here at the end of quarter 3. So if you made it this far, thanks for watching. Please leave a like on the video, and if you find this content helpful, please subscribe. Thanks. Talk to you later.